Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Eric Cantor joins us now, the former House Majority Leader and Vice Chair of Moelis Company. Eric, good to see you, sir.
Good to be here.
We're all trying to figure out how close are we to a point where a leader in America comes out with a set of policies and this market rejects it. How close are we to that moment?
You know, John, it is so reminiscent of the discussion that we had even when I was on the Hill. And if you look back even 10 years ago, we were screaming the same thing, that we have reached a point of unsustainable debt levels. We have to do something about it. And I certainly agree with what both Ken Griffin and Larry Fink have said, that we are on an unsustainable path. I think, though, that the discussion around the debt and deficit is a little bit too simplistic because, yes, it's okay to have some level of debt and deficit. I think most people in their lives have it, and I think the government's the same. I think the trouble you get into is when you start growing that deficit and the debt more quickly than you grow the economy. And there is no agreement, though, on what to do about this. And so if the parties would sort of step back and focus on growing the economy, the decisions to correct the situation would be a little bit easier, the political cost a little less, if people could just try and focus on how we're growing the economy instead of a lot of the policy that's underway in Washington.
Isn't that the argument that the former administration led by President Donald Trump essentially made, that we can pile on more debt, but ultimately we're going to do it because we're pro-growth? Did that work out well?
Well, no, because you've got to address both. I mean, there's no question that it is the demographics in our country and the healthcare costs and the increase in those healthcare costs turbocharged now with higher interest rates. That's where this trifecta of a really toxic mix that we've got that is threatening, I think, the future. And I don't know if we're going to see the two candidates for president, the incumbent, and Donald Trump, ever propose a fix to this, but I think we know how to do it. We talked about how to do it when I was there.
It's interesting that you have both sides of this. You have from the policy perspective when you were in Congress, and you have now from the Wall Street perspective when you're deciding how to invest and where to allocate. How convinced are you that this time is different, that the bond market is going to wake up to the risks that you see from the fiscal side?
Well, listen, I think on the deal-making side at Moelis, I mean, what we're seeing is clients who really reacted over the last couple of years to this volatility and uncertainty around interest rates. Obviously, interest rates, when you're in the deal-making business, are very, very impactful. So, I do think, at some point, the market is going to reject this continued incurrence of debt. I mean, we're spending $1.7 trillion more of money than we have every single year at some point. But again, I always go back to the fact that we're, quote unquote, the fastest kid on the block in this country. Where else are you going to put your money? And whether we're seeing signs of that now in diversification, I'm not sure yet. I'm not sure, because when I look at it and you look at the ADP report out today, we'll get the jobs report out later this week. But, where else is there this innovation and dynamism? I mean, we're on a roll in this country where you've got more small business startups than we've ever had before. That is a signal that people are optimistic about America.
If the market, though, was to push Washington's hand, because Washington is not going to be the ones to come up with a plan for the fiscal deficit, are the right people in place? You had a great relationship in 2011 with then former Vice President Biden. He's spoken glowingly about you, able to work in a bipartisan fashion. Are the right people in place to actually come to the crisis?
Look, I think that the situation will demand that people, step up and come up with a solution. And there's really, to me, if you want to fix the problem and send the signal to the markets that the country and the investors in the markets that the country is on the right path, it's a simple notion, but it's difficult politically. You just take the steps to change the healthcare entitlement, the Medicare program, from a defined benefit system to a defined contribution, and basically offlay some of the risk risk to the beneficiaries. That's really, really tough politically. But if there were a crisis, if the markets did reject what's going on in Washington, you could take more interim steps to go in and tweak the age of retirement, to reduce the indexing of benefits. You could means test. There are some things where you could buy, and the government could buy us a decade plus in terms of the viability of these programs.
That just doesn't win elections. I want to talk about some of the proposals we are hearing from the candidates. Former President Donald Trump is talking about 10% tariffs, a wall, and then 60% blanket tariffs on China. We ran the numbers, and that says PCE would be north of 3% yet again. Yeah. Do you think he would actually do that, given the fact that this can mean such higher inflation, especially on everyday Americans?
Well, you know, I think it goes back to that admonition that someone had given back in 16, you know, don't take him literally, take him figuratively. Who knows? Who knows what we can expect? I think the unpredictability is what he likes. And there's no question that his message is we have been taken advantage of by others, in particular China, and we need to step up and gain some leverage when we try and negotiate some resolution of this situation. But listen, there are very troubling signs coming out of China, separate and apart from the national security concerns around particularly sensitive industries. And, you know, because you think about what's going on with EVs and the fact that the Chinese government is well aware they've got to do something to take care of their domestic economy. So they are ramping up production in their manufacturing sector. And guess what? They're going to have so much excess that now they're already looking like they're sort of dumping all those into Europe, and the EV situation very, very concerning, and our OEMs here are equally, I think, as concerned that may happen.
When it comes to a deal-making perspective, how much are you avoiding cross-border deals because of some of these questions and concerns?
Well, you know, I think it's very interesting because so much of the sectors that investors will look to, really, we're shining in the U.S., and there's a lot of European, Asian, Middle East investors who are looking to allocate their capital here in the U.S., but of course, there are political ramifications to monies coming in, and we've seen that when it comes to countries that are not aligned with us, whether it's China or someone else who is just not on the favored list. You have to go through the hoops with CFIUS and things like that. But I think the real concern that, you know, I continue to hear from clients at Moelis and others is the fact that we've got a situation with our antitrust regulators that it's not just applicable to cross-border deals, it's applicable to every deal. And I think what Lena Khan, Jonathan Cantor have done at both FTC and DOJ has been such a stretch in terms of interpreting the law and the antitrust law. And they've, I think, done a disservice to our country, to investors, and frankly damaging the competitiveness of America as a destination for capital.
That's the world we live in right now. We were talking to Brian Moynihan just the other week on the trading floor of Bank of America. Had a similar complaint. He was talking about the amount of deals that were being held back by the prospect of them just not being able to pass, not being able to go through. And no one wanted to be on the wrong side of that, being left to hang out to dry for a year without any idea of whether the deal will close or not. Are you seeing the same thing? Potential deals that could close that just aren't being made right now?
You know, I do think, and what I will say to decision makers is that, you know, if we're going to go forward, if there's going to be a deal to work, we're going to have to make sure that we allocate the necessary time, resources, and commitment to get through that process. But think about it. If we like to be the location in the world where capital flows to its most efficient use, where it's the most dynamic economy, velocity of capital, we shouldn't have to do this. And unfortunately, there is just an overwhelming ideology that's infecting the policy in the current administration in Washington that is not necessarily that favorable. But again, all the while you look to and say, where else? Or is it any better?
Let me ask you this, though. Is that ideology infecting both parties? Because right on cue, deal crosses the Bloomberg terminal. We announce it. We talk about it. We go to the Twitter account of the Senator of Massachusetts. Tweet. Shock. Not surprised at all. What is surprising is the amount of Republicans that agree with her now. That's a shift. And I'm trying to work out, do we actually have a business-friendly party in Washington anymore? Does one exist?
Well, listen, I always like to say I'm a limited government, pro-free market, pro-national security conservative Republican, but I agree, Jonathan, with your sentiment that Donald Trump has changed the nature of the Republican Party. We are, I believe now, perceived as the working class party. And the Democratic Party has done more to ingratiate itself with, quote unquote, the elite and the very far left on the ideological spectrum. And somehow the extremes are meeting. And you're seeing this happen. And I worry about this because this extreme push in terms of government role in the economy has happened with the support of both parties. You look at the IRA bill, certainly that was one party, that was the Democratic Party. But if you look at the CHIPS bill, look what that did. I mean, that was industrial policy focused on a particular industry that folks in my party decided was a good thing for national security, so let's let the government go all in. That is not sort of the limited government outlook that you see. And so you're right, there is a shift towards labor. Labor is in the polling, public polling in this country at an all-time high in terms of favorability. And both parties, you've seen it. How in the world can a White House go and join the picket lines? That's what President Biden did. But you know what? So did Donald Trump. So did several Republican senators join the picket lines in Detroit.
Well, to Jonathan's point, J.D. Vance, who is a VP shortlist candidate, literally came out and said he thinks Lina Khan is maybe the only effective person in the Biden administration. So say it was to be Trump. Are you getting the same sort of DOJ, same sort of FTC? That's the real question as to whether we're going to continue to see the extremity.
I don't buy that because I still think there is a DNA.
You're a product of that extremity. You lost your seat because of that. And that populist wave that people said, you were really the beginning of it.
But remember where the anger was. The anger really was against the so-called establishment. It wasn't necessarily towards it was towards everything. We thought and probably assigned an overweight to the import of profligate spending in Washington. I think it was just more, it is about the establishment, the system, etc. I don't necessarily think people are going to the polls in November based on antitrust regulation. I really don't. So I think that where you're going to have manifest in a next Republican Trump administration is more of the DNA that's a little bit more balanced and not so punitive on corporates.
People might not be going to the polls, but you have to plan a business around it. And that's really one of the key questions. And we keep getting people in here saying, Lori Calvasina, it's like staring at the sun. How do you plan for something that feels like it is shifting and you don't know exactly how? Is there any way that you are planning with the business and the deal making to get ahead of whatever kind of push we're going to get in November?
So I just think that we've got to be very mindful. In 2025, there will be the Super Bowl of fiscal policy debate because you've got expiration of the Trump tax cuts, and some would say, well, not all of them. Well, yes, there will be. Everything will be on the table. In just to extend the lower, the $400,000 and under income bracket, that's a $3.2 trillion issue. You talk about the debt. Fiscal year 23, we were at $791 billion of interest cost, and we're going up. And so everything's going to be on the table. IRA, the subsidies. I would say if there's any anticipation and advice I would give for those who have been on the uptake in terms of these subsidies with the IRA, especially as it relates to EVs and the renewable industries, we better take a real look to see whether we think those will continue because they're going to be on the table too. I believe my party will first up look at some of those subsidies and get rid of them.
So final question for you, trying to work this all out, because I think this is really, really difficult. In 2016, we had a candidate, and I think if you could divorce the person from the policy you looked at was pro-business, low taxes, confrontation at some point with China. And then TikTok happened in the last couple of weeks, and I was just thinking, is the Trump template from Volume 1 applicable to Volume 2? Do you think it is?
I do. I don't think that he has changed much in terms of his career trajectory. He's always been anti-China. He's always tried to go and gain some leverage in negotiations. He's a deal maker. I also think that he is focused on a growing economy. I think at the end of the day, with all the noise you see from J.D. Vance coming together with Elizabeth Warren and what have you, at the end of the day, the Trump administration next time will be pro-business because he'll want to see a growing economy.
I could talk to you all day. This was great. Let's do it again soon.
Terrific.
Eric, thank you. Eric Cantor there of Moelis. Michael Collins of PGIM saying this: the Fed's own projections indicate a policy rate of nearly 4% by the end of 25, leaving a narrow margin of error for a 10-year yield in the low 4% area. Given the incoming treasury supply and inflation that remains above target. Michael Collins, I'm pleased to say, is with us right now. Michael Collins, did I just hear a little argument there for higher bond yields?
You know, Jonathan, just think about it. If you're the Federal Reserve, why would you even think about cutting interest rates when the economy continues to be really solid? Inflation, as we just saw Loretta Mester say, continues to be sticky and well above their target. The labor market is still rock solid, if not outright strong. The stock market has been hitting new highs. Credit spreads are new lows. Financial conditions are the easiest they've been since just after the Fed started hiking. Why would you cut interest rates with that backdrop, right? So their MO is to sit on their hands, really not do anything until they have to, until one of those indicators starts to crack, right? And we're looking for signs that those indicators are cracking, and they're just not there yet.
So if I called you this morning and said 10-year 437, 30-year 452, would you like some? You'd say no?
You know, we're actually short a little bit, like the very front end, the 2 to kind of 7 year part of the curve, because that's where all those cuts are priced in over the next year or a year and a half. But Jonathan, over the long term, we're sticking to our guns. I'm looking at the 20-year today at 460. And this is what we're advising our clients. If you have a long-term time horizon, 3 years and out, you're supposed to buy long-term interest rates here. There is value. They'll probably be lower in 3 years from now, but it's really the next, 6, 12, 18 months that we're hedging our bets.
How much is that complete faith that the Federal Reserve will be overly cautious in terms of how quickly they'll cut rates? In other words, if they don't really follow through on that and they do cut rates in June, despite some of the strong data, would you move away from that long duration view?
No, I think if they cut rates sooner, it even emboldens the view that those long-term interest rates in the mid-4s are too high, right? Looking at the 5-year markets pricing of what the Fed funds rate is going to be, Lisa. So that's like a really term expectation of the funds rate. It's at 380 today, all right? So the markets are only pricing in about 160 or so basis points of cuts forever. Right. And that's really why we have a stronger viewpoint on the longer term value in treasury yields right now, because I think the Fed funds rate is probably going to average well below 3.8% a year for the next 10 years. Right. And we're just really debating, the next 6 to 12 months. But wow, over the long term, global growth is slowing. China is really struggling. You're seeing inflation in Europe continue to decelerate, right? So, there are big picture signs globally that growth is going to continue to moderate and that inflation will ultimately come down. It's really the challenge has been in the U.S. data.
Which is interesting because this is one of the key nodes of debate, which is basically, are we in a new regime post-pandemic of higher inflation, or to your point, are we not? Would a possible policy shift change that? The potential for a more aggressive protectionist type of policy with higher tariffs and more sort of nearshoring and onshoring of production?
Yeah, the world, Lisa, had been pricing in, and according to our models, the markets were pricing in almost 100% probability of this really, weakflation, soft landing scenario. And we thought, that was too aggressive, meaning risk assets were maybe too ebullient, too optimistic. One of the big risks to that scenario is obviously heightened geopolitical risk. As you point out, the political reaction to that, the stickiness of inflation associated with that. And you're seeing obviously things like oil jumping here, but even some of the commodities that have underperformed, like lumber, natural gas, iron ore, are bottoming out here. So you could have this kind of bounce in commodities associated with some of the geopolitical risk, which leads to stickier inflation, which leads to a Fed that is forced to hold rates higher. And to us, that's a risk to the markets. That's a risk to the economy. That's a risk to credit spreads, if you will.
Well, let's talk about credit spreads. High yield spreads, a little bit wider, still in at around 300 basis points, near multi-year tights. Mike, a question we keep going back to on this program, is that tightness a reflection of strength or complacency? How would you describe it?
It is a little bit of both. The fundamentals Jonathan, in the credit markets. The fundamentals of corporations around the world are actually still really robust. I mean, we've expected profit margins to really come down. They really haven't. Profitability isn't great, but it's okay. Companies have done a really good job managing their balance sheets and their liquidity, and these higher rates really haven't hurt them so much. Credit default rates are not going to surge in our estimation. It's hard to say spreads are cheap here. It's probably even hard to argue that they're fair value, but we have seen in past cycles, and I've certainly lived through a lot of these, where credit spreads narrow, and they stay at these really narrow levels for a long time, years in some cases, and who knows, we might be in one of those environments. But we also have learned that the tail risks are significant, that when credit spreads do widen, they kind of spike wider, and it could be any exogenous shock out of the blue, including the risks I just mentioned. So it's definitely prudent to cut risk here. We are doing that. We are selling into this rally. We've been doing it for a while, continuing to play defense to some extent in the credit markets. But one thing you're seeing, Jonathan, with these credit spreads, treasury yields are high, right? The premium of a treasury bond over SOFR, which is theoretically the real risk-free rate, is very high. So there's already this big supply premium in Treasury. So maybe it's the risk-free rate that's too high, and the corporate bond yields are at the right level. So I think the spread, there's this technical aspect to it, right? There's a ton of supply of Treasuries and not a lot of supply of private sector credit debt. So that in and of itself causes these credit spreads to remain narrower than you would expect.
Mike, this was a clinic. Next time, get in a car, go through the tunnel, get from New Jersey to New York, and we'll do this around the table for a whole lot longer. Michael, thank you, sir. Michael Collins there of PGIM. Love it. Thank you, buddy. Joining us to discuss is Eric Veiel, the CIO and Head of Global Investments at T. Rowe Price. Eric, good morning to you, sir.
Good morning.
Let's just talk about Chairman Powell a little bit later. Have your expectations for the Federal Reserve this year shifted in quite the same way market expectations have?
We were never as excited about as many rate cuts as the Fed had, as the market had priced in. I think one of the things that really stands out to me is if you go back to what Powell said very early on, he was a student of what happened in the 70s. And if you go back and you look at the mistake made then, it was cutting too early. And if you map the CPI to the very beginning of this cycle versus the last, it's following a similar curve. And if they go ahead and they start cutting now, I think they're in danger of making the same mistakes.
Do you perceive that as the biggest risk then, cutting too soon and not holding too long?
I do.
What would that mean for bond markets if they did?
Well, I think you would see what would happen is the spike up, and then you would have to react to that in a way that would put them on their back foot. And that would lose credibility, and you would have a big issue for them.
I want to challenge one thing that you said, which is that Powell is a student of the 70s. Is he really? Because right now he sounds pretty much like the most dovish member on the FOMC. It sounds like he really wants to cut rates. And frankly, a lot of people are looking at that as the reason to buy stocks. Are you saying that they have it wrong?
No, I'm not saying that they have it wrong. I do think he is a student of history, and what he has to do is keep that group, find the middle ground between that group and present it in a way that presents consensus broadly within that committee and balance out the other speakers. So I think he's very much trying to do that right now. But again, I think as you look at the next several months, the idea of cutting when we are where we are from an economic perspective just doesn't, I think, make a ton of sense right now.
Which raises this question, if you do think that this inflation is stickier, and you think that the risk of a 70s type of scenario is greater than the risk of some sort of unforeseen downturn, do you just buy commodities, buy stocks, avoid bonds at all costs? Because right now it's not clear that this FOMC has the conviction to really make the right call and not have a policy error.
Well, I wouldn't go that extreme, right? So as we've unfortunately or fortunately said, we're right now in our asset allocation committee, we're actually dramatically neutral is the phrase that we've been using between stocks and bonds, which is not the most exciting fodder for the media, but that's where we are. I do think commodities, though, is really interesting. And so we are, within our equity portfolios, we're overweight energy in the vast majority of those and in different ways. And we think there are some really interesting opportunities there coming from our bottoms-up work.
Going back to Powell and a student of the 70s, 70s. Does the commodity pressure, you think, and the increase we've seen unnerve him? Because we heard him say that he can cut quickly if they see labor market deterioration. But you're saying he's really leaning on inflation more than he is the labor market.
Look, I can't tell you I know what's in his head. I do think, though, that in the inflation numbers that we've seen have to give you some pause, right? Just as a reasonable place to be. If you were him, what would you do, right? And I think you have to look at that data.
Do you think we have seen a regime shift post-pandemic versus pre-pandemic? And if you do, how is investing in the next decade or so going to change relative to the previous decade?
Without a doubt, we have seen a regime shift post-pandemic. And the issue is all about the absolute low rates that we had heading prior to the pandemic, where it was much more about the macro, right? It was much more about all things up in a zero environment. Risk assets on. In this environment at higher levels, you have to be more, it's much more of a bottoms-up world from our perspective, and it's not as easy in just a chase.
Well, let's get into that because it feels like everything is up so far this year. What shouldn't be up?
Interesting question. What shouldn't be up? We are right now in a position where if you look across our portfolios, we tend to have some overweight positions in a few areas, so mostly in energy and in healthcare. We're relatively neutral in tech, and we've taken some of that from some of the areas like financials and a little bit in industrials where we're a little bit more neutrally positioned.
Well, there's a question here about whether 60-40 works in a new era, or inflation's a bigger risk than potentially stagnation or some sort of recession. How much are you shifting away from that with the idea of commodities being more of a ballast than, say, bonds?
We still believe that there can be some benefit from diversification within bonds, for sure. We've also had a strong view that having a real assets sleeve within your portfolio matters and helps and provides really strong diversification from inflation in a way that many of our peers don't do in their asset allocation portfolios, and that's been a differentiator for us. So we have that component, which has been really helpful.
You talk about financials, that you're kind of not that excited about them, which raises this question: if you believe that rates are going to be higher for longer, why not? Isn't that supposedly good for banks? And weren't we supposed to see them both be able to clip coupons, but also with more kind of robust market activity, collect those fees as well?
Yeah, so what matters, though, is the relative valuation of that group. So I think what you just said is right, and part of that's already been factored in. Banks had a nice little pop, and we were in there, and now we're taking some of that back. So it's more just about price level than it is about that.
Can I squeeze in a baseball question?
Of course.
Just your thoughts on the new ownership of the Baltimore Orioles.
Super excited.
Good news.
We are both. Look, they walked into Pickles Pub, which is the most important bar in Baltimore, on opening day and bought a round of drinks for everybody. So it doesn't get better than that, John.
They can keep buying drinks. I think they've got deep pockets. Keep asking. All right, thank you. It's good to see you.
Thank you.
Thank you, sir. And Mike as well.
And Mike, how's it going?
It was actually Mike.
Was it Mike that went around buying the beers?
Yeah.
There we go.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.